I'm Ben Summers, and welcome to the Shadow Banker's Secrets podcast, based on the book I wrote by the same name. As a boutique investment bank, there are two primary facets of our firm, the buy side and the sell side. On the buy side, we recruit asset managers that are able to generate objectively better performance than what's otherwise available through traditional markets. On the sell side, we provide the capital markets access to that performance through institutional grade funds and private structured products. Today I'm joined by Bill Riley of Riley Private Client. He's a financial advisor with over 40 years of experience in the industry and the author of 40 Years of Investor Mistakes. Bill, Stefan,
Yeah.
It's a pleasure to be with you.
Nice to be here, Ben. Good to see you.
Thanks, Ben, for having me as well. And I'm excited about our discussion today. I know we've had a lot of conversations in the last 6, 7, 8 months here on your podcast on everything that's happening in the global markets and here at home as well. And I'm excited as a retail investor myself and someone that to some extent represents my network of people looking for opportunities as things get more and more chaotic in the traditional sense on how we can protect ourselves and how we can, look for different avenues to maximize any potential opportunity that this chaos creates. And so, Bill, I've gotten to know you a little bit here today, just chatting with you offline, and I'm excited to hear your perspective on things. And I'll kind of give your intro just from what I understand it from chatting with you. So we're going to be joined by Bill Riley, who has, to my understanding, been a financial advisor for 44 years. So you've seen pretty much everything there is to see. You've seen the crash of the early 80s, the .com dip in the early 2000s, the recovery the last several years, and of course 2008. And I know I've already picked your brain a little bit today offline, and I'm excited to do it more for the network here, but really excited to hear your perspective on what we're seeing now, how it compares to things that we've seen in the past. And then Ben, of course, I obviously always am fascinated by your perspective on everything that's going on in the world and see how those two things connect. So honored to be a part of the discussion.
Well, it's good to meet you. And you always gain something when you have these conversations. And I always learn a lot from Ben. He has a similar insight, but he looks at things a little differently than I do. And it kind of opens my eyes.
I appreciate that. And I think that's where the real opportunity lies, right? Is that we all are arguably successful in our respective domains. And it's a nice opportunity to exchange ideas across our breadth of experience and maybe take the best of all worlds, right? Bill literally wrote the book, 40 Years of Investor Mistakes. So I haven't been around quite as long, but I have survived the 2008 market crisis. That's informed my perspective.
And, one of the things I think that's really imperative to me anyway for that, and I think is unique about the three of us, is you had extraordinary success during the 2008 crash. Now, I'm in my late 30s here. That's all I have in my lifetime to compare it to. So when I think about catastrophic or high fluctuation times or chaotic times like I feel like we're in right now, that's what I think about. You had great success. I had the best percentage-wise success I've ever had as an investor. And Bill, just from getting to know his background a little bit, had success then, is having success now. And I'm really excited as we get into a time period where all the, experts on TV are failing. And a lot of the big wirehouses, a lot of the big names in the industry are seeing huge dips or even in some cases catastrophic dips. I'm really curious to hear how three different people from three different walks of life that approach it all a little bit differently, all have had success in comparable times to what we're seeing right now.
Sure. And of course, every time you're experiencing a crisis-like event, it's never exactly like the previous iteration, right? So what we saw in 99 was the dot-com bubble burst. The Fed injected itself into the market and in response created this real estate bubble by dropping interest rates and allowing an influx of capital into the real estate market. That real estate market was then exacerbated by what some might argue is irresponsible securitization, packaging these collateralized debt obligations, mortgage-backed securities that weren't properly underwritten, effectively infecting the globe. So now you have this catastrophe in 2008 when this real estate bubble, and by extension, the global securities market bursts through this infection, was repropped up by aggressive monetary policy that really launched in 2012 through today. And what we've seen over the last decade is that hedge funds really aren't much of a thing anymore, because the only show in town, the only game in town has been the Fed. When the Fed is subsidizing the markets, maintaining low interest rates, increasing the monetary supply, the markets have risen. And what we've seen as of late, just nominal tightening, 50, 75 basis point increases in the Fed funds rate, which may sound like a lot, but as a matter of reference, in 1981, Paul Volcker rose the Fed funds rate to 21%. So we're still low single digits. On a relative basis, that's nothing. So even these small, 50 basis point, 1 point rate increases have caused a $58 trillion drawdown across U.S. equities and fixed income, including government debt. So right now, effectively, it's plain as day, the Fed is what drives the market. So we've seen pretty strong inflation over the past year. In response, the Fed begins to tighten. That crashes the capital markets. Now, what happens next? What can be done? Well, the math shows not very much. So the Fed will probably try to continue to tighten as long as it can, hold and bluff as long as it can. But there's going to be a point where every financial institution in the world will be insolvent. Why? Because everybody is holding low yield paper. What happens to bonds when rates go up? Their value goes down. And by virtue of the volume of this low yield debt held on the balance sheet of every financial institution in the world, eventually the Fed could bankrupt, make 2008 look like a blip. So it can't raise rates much more, if any, and it certainly can't sustain those rate increases. So eventually the Fed's gonna have to capitulate. And then what happens, right? My fear is what you might describe as a hyper stagflation. But again, timing is everything. The Austrian economists have been claiming the sky is falling since 1971 when Nixon closed the gold window. But again, Bill, you've been around for over 40 years. What's your take?
You're exactly saying it right. And of course, my little theme is, history may not repeat itself, but it sure will rhyme. And what we're seeing today is very similar to what we saw in that horrible weekend when, Volcker did raise those rates. It was a real debacle. And so what we're seeing today is just a replay of what I feel like is a Fed governors that really have never really been in business. They're more politicians and academics and not really understanding how things really work and why it works. And so we're seeing this, and it'll play itself out. Will we have a robust economy again? Possibly. But I think with the way things are right now, I'm worried just like you are, man. Stagflation is tough. I had to manage through that back in the 70s, and it's very difficult. If you put money into the S&P 500 in the early 70s, it took until 1982 before you actually made any money. You could have bought the S&P 500 and basically you made no money because of those problems. And we may be running into that if we're not careful. We don't have the leadership and the brains to say, hey, there's a way to fix this.
Yeah, there just doesn't seem to be the political will to ever do the right thing. And that seems worse now than it's ever been. So we're kind of left to our own devices. And I'll tell you internally what we have done is, again, I don't think there's much that can be done if you're looking at purely public markets. And again, FINRA will publish this on their website. You cannot diversify away market risk. And so
Yeah.
we've really pivoted into GP stakes positions where we are buying the compensation of institutional grade fund managers. Because remember, their management fee gets paid no matter what, right? So even if their strategy takes a dip, their AUM may take a nominal dip by virtue of a loss in the performance. But all these guys are in private markets anyway. They're not super volatile. They can value on a mark-to-market basis. And so even if their strategy is flat or even down a little bit, we've still got the income from their management fees coming in. The performance fee is just a bonus for us. So that's a fairly esoteric position. We're fortunate to be in a position to access those types of things and even engineer and design them. But it does seem to be a really tough spot for the market at large, because it doesn't seem there will be any point of or place of refuge in traditional markets.
I agree with you. It's going to be difficult.
Yeah.
It can be done, but it's going to be difficult.
Sure. So I know, again, you've got decades of experience and you've survived, and not only survived, but we talked a little bit about some of the active strategies that you deployed 2008, right? Where you effectively shorted the market successfully and did well. Do you see any similar opportunities from your vantage point today that are similar to what you saw at 08, 09 era?
Well, you remember 2008 was a financial crisis, and the banks are still very strong right here. That's what really gave us the firepower there, because we knew the banks were in trouble and we knew what was going to happen. Today, the market's come down enough, it's hard to short, on a down market. But I think if we see any problems, where there's an opportunity to make money, it's almost going back to the basics. It's almost going back to good companies, good balance sheets, good cash flow, kind of like the old school fundamentalist. And there's some money to be made there, because a lot of companies are selling at ridiculous prices. I mean, you take Goldman Sachs this morning, they're selling one times book. That's ridiculous.
Sure.
Those are the opportunities you have. But then you turn around and look at some of these fintech stocks that it's like the old .com days. Now their PEs aren't as bad as those were, but we're looking at companies that have PEs of 55 and 60. That means you got to really grow to maintain that price, and it's not going to happen because there's too much competition, and that's what's going to happen. I think that if I was a short seller today, I would still short China, because I don't think they're out of the woods. I would some of these flying tech stocks that really don't, that the price that's on them, now they've come down a lot, but the price that's on them cannot be substantiated. And you can look at some of the ETFs that have come out, ARC, and those right there is a good proof of the pudding right there, that she went after a bunch of stuff that she shouldn't have. And now she's off 45, 50%, because I don't know what happened there, but it didn't take much common sense to have a DocuSign out there paying, that was selling at $500 a share and a PE of almost 90. Something has to give. Great company. We used it every day, but the price didn't meet what it was worth. And I think that's what low interest rates do to you then, is that when you have these low rates, people get overconfident. And as rates go back up, you reprice everything. Homes are being repriced. Real estate's being repriced. So that's what really brought this on, is the speed of this rates going up this fast. I've never seen this in my career where now sure, we're not real high, but still 75 again. I mean, Volcker didn't even do that. He only raised it 2% because it was way up there. But that is a fast move.
Bill, you're touching on exactly where I was kind of wanting to go next. That's why I apologize. I don't want to cut you off, but I'm really sincerely curious to get both of your opinions on this. And we talked a little bit about this offline as well, but it feels to me, and again, both of you are kind of light years ahead of me as far as the institutional world of investing goes, But in layman's terms, when I look at things, the last really 5, 6, 7 years here, it feels like everything's happening at lightning speed to some extent. I remember, back 2017, 2018, during the second to last Bitcoin boom, I was talking with my brother and we bought some Litecoin and we were joking about it, like, laughing. Tomorrow it'll probably be up 25%. And it wasn't. Tomorrow it was up 56% the next day. And then it was down, 70%. And it just seems like market cycles that used to take years now take months, and market cycles or blips that used to take months now take days or weeks. Do you both agree with it? Am I from the outside looking?
Yeah, I would say that's not a market cycle. That's just very bad volatility, right? That happens. I mean, particularly in unstable times, right? Not to be too dramatic, but if you look at Weimar Germany, right, there was a tremendous amount of volatility preceding hyperinflation. Now, am I saying hyperinflation is imminent? No, not necessarily. But my point is that's not necessarily a cycle. That's just arguably transient volatility. And to Bill's point, volatility by definition is risk. Of course, that's one order of risk. I'd argue that you have to look at all 4 statistical moments, including skewness and kurtosis. But to the point, risky times, volatile times also do create opportunity. Like Bill pointed out, like you can get Goldman on a fire sale right now, right? So, but to your point, Stephan, about markets moving quickly, it looks like, for example, the real estate market is moving fairly quickly, right? Like it's on its way down. Between 2007 and 2011, that real estate crash was effectively a 27.5% national average drop. So it took 4 years for the national residential market to fall 27%. This looks like it might go a little faster.
Well, no,
it certainly went up faster. Right.
Yes, sir. Yeah. Well, and to your point, Ben, and I've seen it, and just being my friend, talking with me personally, I was trying to sell my house in Tahoe in March of 2022 to now. It's down 30% in what is that? 6, 7 months. So yeah, that's what I mean exactly, and that's why I'm genuinely curious to get both of your perspectives on it, because I don't know if it's just me or what, but it feels like these 25% drops that you're talking about, you hit it on the head, that took 3, 4 years now are happening in 3, 4 months. Right. And as anecdotally, just because of my background and the success I've had in chaotic markets, I feel like that must create some type of huge opportunity.
Oh, it will. It will. One of the things I've seen around here with housing is that, people were asking 1.8, 1.9 for a house. Okay. That's the average around here. Well, my sister's in real estate, and now people are getting scared. It's the seller that says, see if they'll buy for 1.6. And it was 1.8 2 months ago.
Yeah,
because they're scared. They want to get out. So it's like a fear factor. Oh my gosh, I got to sell this house. What will they pay me for it?
Yeah, no. Well, and Bill, and
6 months ago, they were taking bids out in the front lawn.
Exactly. My brother Bill, that I told you about it by you there in Plano, that's trying to sell his house right now. He's moving to DC, but he calls it revenge of the buyers, because when he bought his house in Plano literally 12 months ago, it was, like you said, it was, you better bid 10% more, and then you still didn't know if it was enough. And he bought it for $579 a year ago, and he listed it for $629 at first about a month ago. Now he's all the way back down to $579 where he was. And he's thinking about, he's asking me my opinion. He's like, should I lower it more? And I'm like, well, hell. And it's just what you said. And it's that chaos, man. But I think, do we all three? I know Ben's answer, I think, is I've asked him this. Bill, I'm curious yours too. But do we all get incredibly excited about this though? Because it does create an opportunity, right? It really does. And we've all experienced that in our own way.
I'm looking at, some real estate deals. that for a couple of my clients, and we're waiting. We're being very patient because we know the price is going to continue down, especially in the warehouse market. They like to buy warehouses, and those are starting to come off. You know, Amazon closed a bunch of theirs, and we're starting to see that retraction. And a lot of it's because to get the money to buy the house, to buy the warehouse, you're paying 3 times what you were. So that causes the valuation. When you do your valuation, your capex, you're going, whoa, you know, I can't afford to pay that much for that now because the money's not cheap anymore.
That too. Yeah, that too. Yeah. Well, and Ben, I mean, I don't know if you guys have already talked about it, but you had a lot of success kind of riding that wave in 2008 with your kind of asset-based lending, right?
Yeah. So I think that's where people sometimes get a little bit confused about what we do and what our role is in the market. So again, we are not advocating for any individual asset class or strategy. We are simply advocating for and executing accurate risk-adjusted performance measures and making allocations based upon those measures. So we go wherever the best performance is, no matter where it is, without any emotional attachment to any asset class or strategy. Doesn't matter. Could be equities, could be real estate, could be private equity, could be long short hedge funds, could be little kids cutting out cardboard elephants. As long as those elephants are generating yield in bad and good markets, we don't care, right? And so for us, it is an opportunity because we underwrite our performance across previous market bottoms. And we've already seen some really bad stuff. We've already seen the inflationary environment of the 70s. We've seen the crisis of 2008. We've seen smaller versions of that in the 80s, right? The S&L crisis in 88. So we take all of that information and we underwrite our strategies and engineer our funds to be robust against that. So we can help people, right, who actually care about merit, right? Whether it's an advisor like Bill or a retail investor, if you don't want to have those bad calls, right, we can construct portfolios and have assets that are robust. And furthermore, obviously, the disclaimer goes, past performance is not indicative of future performance, but epistemology 101 tells us that it's the only thing we got. That's how we make decisions. The only way you make a decision about the future is based upon what you've seen in the past, whether you realize it or not. And so we're just doing that in a very rigorous, objective, quantified manner. And so because of that, we don't necessarily fear the downside because we know that it's like Michael Jordan says, or not Michael Jordan, Kobe Bryant would say, why do I look calm, cool, and collected in high pressure moments? It's because I've done this 1,000 times before. Well, we've done this market, at least virtually, 1,000 times before in our underwriting process. So obviously we don't welcome it. We don't want to see people get hurt, but we were created and we exist for the purposes of preparing and making sure people are protected through these through times like this. Bill, I know we're cutting short. Do you have any final comments or thoughts or ideas you want to communicate before you have to run?
Well, I'll leave with this. It's really hard to make money at the market top. It's pretty easy if you can get pretty close to them. You can't call a bottom, but you can make a lot of money come off the bottom. And that's where we are now. It's going to be some challenges. You have to pick your spots. But like we talked about, some of these banks are selling at prices that are theoretically ridiculous.
Bill, Stefan, it's been a pleasure, insightful, and hope to do it again soon.
Very good. Thank you, Ben. Thank you, Steph.
So that was Bill. He was great, wasn't he?
Yeah, I'll tell you, Ben, I'm excited that we got the opportunity to hear Bill's perspective because I think with everything that's going on in the markets right now, honestly, the more opinions, the better. And obviously, he's got an extremely impressive background and he's been doing this literally longer than I've been alive, actually. So, I mean, I'm always thankful to hear from anybody that has that type of experience. And one thing that I wanted to kind of check in with you on, Ben, and talk a little bit more about here, just to recap that we didn't discuss much when he was on. Bill mentioned with all the chaos and all the market volatility that we're seeing, that most of the firms that he knows, RIAs, are down, pick a number, 25%, 30% the last 6 months. And a lot of his clients and even other RIAs are coming to him because he's been able to do so well with some of the strategies he's implemented that he's only down 11% the last several months while all this has been going on. And I feel like it's worth mentioning just because, like I said, we need all the help we can get in these times. What's your performance year to date while all this insanity is going on? And more importantly, perhaps, what are some of the strategies that you're implementing to get the types of returns that you're getting?
Year to date, we're up a little over 50%. And that's attributable largely to our rotation into GP stakes. We've really been focused on that area as of late. Now, in fairness to Bill, I guess he could have access to that if he was sort of willing to have the conversation. But I think we tried, and it went a little bit over his head, and I think he lacked the patience for that sort of learning curve. But for those who do, that theme I tend to repeat all the time is that if you're smart, curious, and independent, opportunities are there, right? Now, GP stakes, for example, again, where we're really focused, is not available in it's not a public market trade. You're not going to find it on your Schwab platform. Again, this is why the sophisticated institutions allocate the way they do, and why it looks so incredibly different than what you're typically going to see through your retail financial advisor.
No, that's so true. Well, and that's why you and I have, in these podcasts and other materials that are out there, have spent so much time trying to educate not only the general public, but also even really successful, really sophisticated RIAs like Bill, right, on the GP stakes opportunity, because it's there, right? I mean, it's something that's been in place, and people can hear us talk about it in other content ad nauseum, so I won't go into full detail here, but it's an opportunity that has been being executed on for decades and decades by some of the big firms on Wall Street and et cetera. The only thing that's unique about this is really kind of the first time that I'm aware of anyway, to where it's really been made to the general public available as an option, right?
I don't know that GP stakes have necessarily been around for decades per se, right? I think it, at least in terms of its popularity amongst the top institutions like Dial and Goldman, I mean, they have about $25 billion allocated across their GP stakes fund. So relatively speaking, it is a very small capacity constrained strategy that only the most sophisticated of sophisticated institutions are partaking in. So it's not necessarily a very old strategy, but it is a sort of a twist on a well-established structure, which is the fund structure. And it's a really esoteric, sophisticated play that it's understandable why, your typical retail advisor might not be receptive to it, right? Because they're used to, their business model, and God love them, their business model is to sell easily sellable products, which means simple, familiar, right? And, if that's what people demand, that's what they get. And, as with every business, consumers, I think, tend to drive what businesses deliver.
Yeah, well, and I want to be clear too, at least, from my perspective, Ben, I don't want in any way to sound like this is a criticism on Bill, because it's most certainly not. In fact, it's the opposite, in my opinion, because with everything that's going on right now in a retail financial advisor setting, to only be down a small percentage when everybody else is down massive 20, 25, 30%, that's a huge accomplishment. The reason I think it's really awesome, for lack of a better word, that we had the two of you on today discussing the things that you've both been successful with in the past and are being successful with right now, is because I do think he's an example of someone that thinks outside the box in a lot of ways from the traditional sense, And then what you've done and what you continue to do takes that almost to light speed to where it's like, wow, in a down market, in a chaotic market, not only can you weather the storm, but you can feast on it. That's the way I see it anyway.
Yeah, and I would agree. And I think amongst the retail advisor crowd, Bill is in the sort of the upper echelon of what's available there, right? Like his performance has been good on a relative basis when you compare it to his peers on the retail side. So again, there are a lot of forces at play that determine what financial advisors do, how they do it, what they offer, and why. And again, if you've got consumers, clients who prioritize simplicity and familiarity with who prioritize simplicity and familiarity over merit, then give it to them. Now, I dare they don't take that approach with their physicians or with their lawyers.
Yeah.
But it's their prerogative to do that. If they choose with their money.
That's a good analogy. It's kind of like if some doctor comes to you and says, hey, you've got cancer and we've got this new experimental treatment that can probably cure you, and the track record says it can cure you, and then the customer just says, no, you know what, I'm just going to go and get my teeth whitened instead. So
yeah. I mean, oh no, we can't. I can't have that triple bypass because I'm not confident that I could do it myself.
Yeah. Yeah, that's the threshold that we really very few things, honestly. So
yeah.
Anyhow.
I don't understand how neurosurgery works, so therefore we'll just go ahead and eat the fucking seizures.
Yeah, well, I mean, it's true, and I mean, it may or may not sound dramatic to use these analogies, but to me, it's the exact same thing, because it's that fear barrier of the general public that they hold themselves back from opportunities that can be incredibly prosperous and completely change the quality of their life. I mean, it's a huge second to health. I mean, it really, what's more important than that? So anyhow,
I mean, it's the financial equivalent, right? But then like the tragedy is that you'll still hear the sort of the public, the retail crowd complaining about, like the top 1% and, all these assholes with money.
Yeah, that's true.
There's a reason for that, right?
Yeah.
And look, opportunity for everyone is scarce. I'd argue that in a person's lifetime, you probably have a handful of life-changing opportunities to pursue.
Mm-hmm.
And you don't get that many mulligans.
No.
And it's those who have the wherewithal to recognize what's in front of them and to move on it are the ones who have a different lifestyle, right? So I don't mean to get too terribly philosophical, but I think that this example and just the general retail advisory world and the criticisms and the complaints versus the type of decisions and the decision making that's done, like that's what you get. Right?
Well, and I'd double down on that, and I would say, and even to bring it full circle with today's discussion with Bill and with you and what we're talking about now, I would say, hey, if you're the type of person that you just want to acknowledge you are afraid of anything you're not familiar with, you don't want to take that risk, you're still taking huge risks.
That's not a risk. I'm going to interrupt. That is not a risk, right? And here's the analogy. And I don't mean to protract this point, but it's hugely important. I get really worked up about it.
Yeah.
If you don't know how to fucking fly an airplane, does that mean that air travel is riskier than driving?
Yep. Well said.
No. Your ignorance is not tantamount to risk. Full stop. And so even you, like, better, right? But even you said it. well, I'm taking a risk. No, that's not a risk.
To be fair, I was going to say kind of a softer version of what you just said, but I'm happy you said what you said. I was going to say that, it really isn't a risk, and you're actually, because it pisses me off too. I'm happy that you did jump in and say it the way that you said, as forcefully as you did, because it needs to be said, and it's just accurate,
Yeah.
But and it pisses me off too, because even things, it's just all perception, right? Because there's things in the market, like a money market account. I've told that story before on previous webinars I've done and podcasts about how I called up T. Rowe Price because I had a college savings 529 and I had it in a money market. And I asked them about the risk associated with my 0.25% return that money market was getting. And even that's not guaranteed. There's risk. There's actually more risk in being a slave to the market conditions. If you look at the historical track record, your historical track record, and the stability of GP stakes, I agree with you 100%. It's actually less risky than just being in a standard fund, a standard, 20-year.
I'll put a finer point on it. Risk is an absolute, objective, measurable quantity. Your ignorance does not change it. It's not a function of your perception.
Love it.
It's an absolute independent quantity. And it's up to you to not be ignorant, to be curious, and to investigate where that risk actually is and make prudent decisions based upon that insight.
And perfectly said, honestly, man. And that's kind of where I was going with that too, is that, like, hey, if you're that person that's not curious, you don't want to look into anything you don't already know, even though, again, you don't really know anything about how these mutual funds you're investing in operate. But if you are comfortable with that because that's what society's told you to be comfortable with, you just want to stick with your head in the sand, great. Then in that case, if that's your crowd, you're not going to find probably an RIA better than Bill, for example. If you just want to stick with that traditional mainstream philosophy, that's
true, because I don't want to talk to you.
Exactly. And that's what I'm saying. But if you want to take that step, if you want to look into alternatives that actually have a better historical track record, that's factual data that can be backed up with results, probably a good idea to look into some of the stuff we're talking about. So anyhow.
Yeah. No, well said. It's nice to have this conversation with you, because it is rare to find what I would consider to be, or what should be, fairly common and simple personality traits, which are just relatively intelligent, curious, and possessing the strength of character to think independently. But it's disappointingly rare.
It is, but you know what, Ben, honestly, and I say this all the time, one of my favorite sayings is, if it was easy, everybody would do it. And it really does take all kinds. I'm happy that there's such a large percentage of the marketplace that doesn't think the way that we do, because if everybody did and everybody realized the obvious opportunity, then that opportunity probably wouldn't be there to the extent that it is now, right? So I think that, you attract your own tribe. And they're really, while I want every member of my network to at least go down that road, explore some of the strategies we're talking about, because I genuinely believe it will better their lifestyle and ultimately their life, it's not for everybody, and that's okay. Everybody has their own lane and they can stay in that. But I think for those in the network and those that hear this content that are curious, that do want to invest in their future, I think it's obviously highly worth the time. So I'm thankful that you allowed me to be part of this discussion and got to hear your perspective, Bill's, and throw in whatever 2 cents I have as well.
No, I appreciate that. And you can see and hear maybe a little frustration, a little disappointment in my voice, right? And where that comes from, immediate experience, right? So we're institutional facing. We work with, fund of funds, small pension funds, and endowments. And like Stefan, we're working together, running a pilot program just to give the public an opportunity to access some of these things. And we're providing them gold. And just the pervasive lack of just simple curiosity and adherence to dogmatic beliefs about money and investing are just pushing us right back where we came from. This is precisely why we are interviewing potential retail investors as LPs.
Yeah.
Because again, our business is institutional facing. We want to give people a chance, but we don't want to give ourselves brain damage in the process.
Yep. Well said. And that's just the factual reality of running a business, right? I mean, your time is your most valuable asset, and it needs to be explored as much as I know you want to give that opportunity to the masses. And I know I'm passionate about it as well. It has to be economical for, both the bottom line and for your time. And so I'm excited that you've given that opportunity kind of as a trial run there for the LP side and individual retail people like me to be a part of the strategy. So anyhow,
I wish more could be like you.
well, I don't know about that, but no, all good things, my friend. But no, thank you again for having me on for the discussion today. I think this is one of the more valuable ones that we've done so far on your podcast, and excited to see what happens next.
I appreciate that. It's been fun indeed.